Carl, thanks for joining us.
Good to be with you.
So it's been 6 years since the financial crisis, and the housing market still seems sluggish. What's going on?
Housing is usually an important driver of economic growth, especially coming out of recessions, but that has not been the case this time. And in particular, 2014 was not the best of year for housing because we saw sales of houses actually decline over the prior year, and construction activity is still only about half of what it was prior to the peak. So it is not contributing to American economic growth the way that it normally does.
So mortgage rates are very low. Why isn't that having more of a positive effect?
In recent years, investors have taken a prominent role in housing purchases, scooping up scores of distressed properties to turn them out for renting. Those investors haven't needed to borrow, so mortgage rates are less of a factor for them. But now as we try and see a rotation towards organic first-time home buying, rates are still not having an effect because the millennials, the generation that would be buying those homes, is still struggling with student debt, is seeing their careers in some cases get off to a slow start, and their attitudes towards housing may be influenced by what they just saw their parents go through in losing their home equity.
What are some of the other key factors that may be holding the housing industry back?
I think the mortgage industry is still adapting to the new reality of regulation that came on in the wake of the 2008 financial crisis. They've now been asked to establish that borrowers have the ability to repay their loans, and the penalties for failing to do so can be rather substantial. So I think some institutions are choosing to take a wait-and-see approach instead of extending new mortgage credit, especially when borrowers' balance sheets are not in great shape.
There have been some ideas put forward to aid the housing sector. Can you walk us through those?
The federal mortgage agencies, Freddie Mac and Fannie Mae, have some limited programs where they will purchase loans that have only a 3% down payment, which is a very, very thin one. And in addition, the fees that some of the agencies are charging to guarantee the performance on loans have gone down. These are intended to bring demand forward, but I think we might want to be very careful with those sorts of measures because after all, it was that sort of thinking that got us into the mess that we're still cleaning up. It may just be best to remain patient and let nature take its course.
Well, Carl, thanks very much for joining us.
My pleasure.
Thank you for listening. For more insights from our economic research team, visit northerntrust.com/view.